Hello everyone, today, December 7, in 5 minutes with 4 key charts, we're going to conclude on 3 takeaways for markets with 2023 already drawing to a close and on track to end on quite a strong note for equities thanks to a substantial rebound during the month of September, which has given rise to gains that are better than those seen on the bond markets, although there as well we have witnessed quite a rebound over the past few weeks, which is definitely good news for Canadian bond investors, knowing that we had just suffered 2 consecutive years of losses. We're finally renewing with gains on this front, although gains are ultimately comparable to those earned from simple risk-free assets such as cash, which in this case is actually the best return since the early 2000s. And broadly speaking, this market review can be explained with one thing: monetary policy, with interest rates being at their highest level since the early 2000s. That explains cash return, but also rate hikes being now discounted in the increasingly near horizon that has helped Canadian bonds, plus all of that without seeing too much damage on the economic front, which has put a floor on global equities. And when you look forward, it is indeed totally reasonable to expect that rate hikes are behind us. But if you were to ask a mountain climber, he'd probably tell you that you shouldn't underestimate the challenge associated with the descent, as this is typically when fatigue is most acute. And the same thing applies to the economy that is likely to show some signs of weakness next year, some signs of fatigue, even though rates could come lower. And just to put things into perspective here, remember that rates went a lot higher than it was initially expected at any point in time over the past 2 years. Specifically 2 years ago, the end of this hiking cycle was foreseen at 1.5%. When it started, the end was foreseen at 3%. Over the past year, that expectation fluctuated around 5%, but we ended up going all the way up to 5.5% in the US, with now, again, rate cuts being discounted in a later stage of Q2 next year, which is a plausible scenario when you're seeing the progress that we're seeing on the inflation front. You know the story here, went all the way up from 9% to 3%, quite a slowdown, not sufficient to get in the Fed's comfort zone. But when you look ahead, what you see first is, again, a lot of uncertainty, let's be clear, but you see that it is entirely feasible to expect inflation on an annual basis to be in the Fed's comfort zone by sometime in April or May next year, which would then open the door for rate cuts. Now, what seems less reasonable to expect is the resiliency of the economy in 2023 to carry on in 2024. And specifically, we'll have to monitor closely what's happening on the labor market front. And we can understand it here. It's hard to contemplate any substantial increase in the unemployment rate given the labor shortages that are still ongoing. And indeed, the unemployment rate hasn't increased all that much from its recent low. Yet if you look historically, you see that every single time that we've had an increase in the unemployment rate, just like the one we've just had, every single time this marked the beginning of a more substantial slowdown in the economy, with an increase in the unemployment rate and ultimately a recession. So current economy is pretty unique on many levels, but faced with such signals, I think you'll agree with me that it's not the time to be too complacent. So to recap things off, 3 takeaways. Over the past few months and weeks, markets have essentially been celebrating the end of rate hikes, with inflation slowing down and the economy resisting, leading many to expect that this would also be the story next year, which on some part we agree in the sense that inflation is indeed headed lower in our view, which would then open the door for eventual rate hikes. But if history is any guide here, we must expect more economic turbulence with a watchful eye on employment, and that still, for us, argues for a prudent investment strategy with one important nuance. With the risks shifting from inflation to growth, the attractiveness of bonds relative to equities, but also relative to cash, has increased materially over the past few weeks and months. And as such, even though we expect a lot of volatility next year, investors will be better off not to fall into the trap of holding on to cash for too long. There are opportunities today, there will be opportunities next year, and we'll have to remain on the lookout. On that note, wishing you all happy holidays, and we'll talk again in 2024.